The global oil market has spent the last few years adapting to one disruption after another. The growing security risks in the Red Sea have raised concerns that the Bab el Mandeb Strait could become effectively closed to commercial shipping. This is not simply a story about one shipping lane. It is a story about the global oil delivery system potentially losing yet another safety valve. To help us understand what that could mean for crude oil, diesel, and global energy markets, I'm joined by Alex Hodes, Director of Energy Market Strategy at StoneX. Alex, good to see you again. So we have focused so much on the Strait of Hormuz, but how important is the Bab el Mandeb Strait to global oil and energy trade?
So as you kind of stated, is that we have all these kind of cushions in place, release valves in place, and that has made the Red Sea in particular more important to the global crude oil and refined products side of trade now. So prior to the conflict and the closure of the Strait of Hormuz, the Yanbu Port from Saudi Arabia was taking about 2 to 3 million barrels per day of crude oil and refined products at its port. That's essentially just to kind of divert away from the Strait of Hormuz. But after the conflict, they ramped this up to full capacity and has been hovering around 5 to 6 million barrels per day of crude oil and refined products, at certain times hitting 7 million barrels per day. And that has been kind of a big release valve on the oil market in general. And so now that we are already seeing that release valve being kind of pushed to its limits, closing the Red Sea kind of constrains that a little bit more. So there are alternative routes, and that would be one going up north to the Suez Canal or loading in the Sumed pipeline, which takes barrels from the Red Sea to the Mediterranean as well. However, there are some constraints here, and we could see a little bit of a delay in some of that supply being offloaded through those routes, and it will add on time from Asian buyers in particular who are looking for crude oil coming out of the Yanbu port.
Yeah, if the Red Sea became effectively closed, which we hope it doesn't, who would feel the impact first?
So I think it kind of goes back to who the buyers of the Middle Eastern crude oil and refined products are. So a large amount of the European buyers have been buying diesel loaded in Yanbu Port. So they will start to feel that. You're starting to see that reflected in the European gas oil pricing. Diesel has already been tight globally. So you've seen European gas oil, in addition to NYMEX heating oil prices in the US, are all moving extremely high. It's kind of hitting the refined products out of Russia have been banned, so diesel exports. It was already a tight market there, so you're starting to see kind of diesel markets take off ahead of the rest of the group. But then for Asian buyers, when they are buying from Yanbu Port, it usually they would usually route around the Red Sea through the Bab el Mandeb and go towards Asian buyers. However, now they have to route through the Suez Canal, and that adds about 30 days of transit time. So in addition to just the delay you're seeing there, any potential constraints you might have in the Suez Canal, you're seeing just a lot more friction in the system overall. You're going to see freight rates tick up higher. Some of these ships might not be able to pass through the Suez Canal if they're fully loaded VLCCs. So they'll start to use kind of different smaller tankers to transport some of that product as well. But those are kind of the two main areas. But as we all know, the market is very global, so you're going to see kind of shock waves throughout the rest of the world from that.
And not to mention all the additional fuel you need for those longer journeys. So you mentioned a couple of alternative routes already, but if shippers do need to avoid their usual routes, what alternatives are available to them? I mean, for example, I would think of Cape Good Hope. How much more expensive are they going to be?
So it's going to add on quite a bit of transit time. So 30 days transit time, that's a substantial amount, and it will increase the amount of oil used. But as we've seen with other kind of sanctions that cause disruptions in flows, typically you see a transitory period to where the market is kind of figuring out these new routes, and then the market really does adjust. So I would imagine that we're not really going to see a massive price spike on crude oil in particular, just due to the closure. We could see some temporary disruptions on the order of 500,000 to 1 million barrels per day, depending on if those barrels are able to be offloaded in Yanbu Port and then kind of transit through the Suez Canal. So it's really going to be kind of this transitory period, probably a month, couple weeks before you start to figure out these flows. And then perhaps there's going to be reroutes from one place to another to kind of make sure that everything's going as efficiently as possible. But it does throw some friction in the market and put a potential for disruptions to global supply. But those are going to be much smaller than the disruption we're seeing in the Strait of Hormuz.
So if these disruptions were to last a long time, though, could the market adjust like it has been? Or do you think that we're looking at a fundamental shift in how oil moves around the world from now on?
So I think there will be some of the Asian buyers, they might have more access to crude a little bit easier because they're now going to be transiting to the Mediterranean. And there's not as much, essentially the tankers are going to have to go through the Mediterranean. So you might see pockets of there's more supply here than there. So yes, the flows will be changed, but whether it disrupts the actual global supply demand picture remains to be seen. And so whether it's actually an extremely bullish factor in the market is something that I think we don't believe it's as extremely bullish as we initially thought it could be. There's going to be a little bit more tightness on the refined product side of things. And that's due to now you're going to see crude competing over diesel in certain places. Diesel is going to have to take they're going to be competing over tanker space as well. Because crude oil is not going to be shipped in as much of the very large crude carriers, the VLCCs. They're going to start to use other ships to kind of transit through the Suez Canal. So it's going to bring up freight rates overall. So what you could see is more dislocations in essentially regional pricing locations. And it's going to demand a little bit higher of a spread between those areas for product to move from point A to point B. So it could increase these freight rates, and that's going to add some extra costs in the logistics. But the overall oil price, we're not expecting the supply demand to be extremely affected by that situation.
Okay, well, you sort of just answered my next question about where do you see the biggest impact being felt first. And I think it's safe to say it's diesel, correct?
Correct. And that's, again, it's almost the fact that we have already had so many disruptions due to diesel. Refining capacity has already been constrained in the past. So we've had tight supplies. It's made diesel a lot more reactive. And that's kind of made diesel kind of the front runner to all of these situations we're seeing. And on top of that, you're seeing the issues in Russia as well. So refining capacity has been under attack there, and they are a major diesel exporter. So really can't catch a break for diesel. And that's why I think that's kind of taking the lead here.
Okay, well, actually, let's talk about Russia, because we've talked a lot about the risks in the Middle East, but another hot spot is beginning to emerge, and that's the Black Sea. What impact could the latest escalation there have on global oil markets?
So there was temporary issues to the CPC terminal, which transports crude oil from Kazakhstan to the Black Sea. And you are seeing those exports being affected. Reports were that was kind of coming back online as soon as this week. So that originally took off 1 million barrel per day of supply. That's since been repaired. However, it really just displays that these Ukrainian attacks can basically penetrate very far into the Russian in all of Russia, and it leaves a lot of their refining capacity, crude oil production at risk, and that's a risk that needs to be basically baked into the crude oil, diesel markets in general, because they are just not as reliable as of a global supplier due to these kind of risks of literally the infrastructure has been on export loading facilities, it's been on refineries across the country, storage facilities. So really have not really been any targets that are off limits.
Yeah. And countries like China, India, Turkey have obviously benefited a lot from this discounted Russian oil. What happens to them if that flow is disrupted?
So they actually, in the recent attacks under the refineries in particular, you've actually started seeing Russia start to export almost more crude oil because they can't store as much at home. They're not running through as many through their refineries. So it's actually kind of even discounting some of the crude oil a little bit further. However, you are seeing overall crude oil prices move up higher just due to the Strait of Hormuz. So everybody's kind of feeling the price pressure of crude oil prices moving up higher. However, Russia has actually started to increase some of those barrels abroad. And so it's kind of more where people are feeling it is the refining margins have moved up substantially higher.
Yeah.
And the refinery constraints are under more pressure than anything out there. And Asian buyers in particular, they are the ones that have been really kind of at risk due to the Middle Eastern supply being at kind of on and off. Asian buyers, Asian refiners are really the ones that are first and foremost affected by that crude oil outage. And so they have been looking to discounted crude areas, Russia in particular, and grades of crude that are just essentially very similar to the Saudi Arabian, the Middle Eastern crude that they're used to running through their refineries.
Yeah. Understood. Alex, thank you so much for all your insight as always and for joining us. And thank you to our viewers for watching. For more financial content, don't forget to like and subscribe to our channel. We'll see you soon.